Hi, I'm Chris Sabula, and I'm here with Mark Armbruster. We're revisiting an investment topic that has already been vigorously debated and discussed for decades, and one, frankly, that we thought had kind of gone away. However, as a result of a sharp turn in the stock market lately, the topic of active versus passive investment management has resurfaced.
Around and around we go. The world is full of misinformation on the topic of investing. Large investment firms spend millions on marketing to convince investors that their way is the best. However, these messages often conflict with actual data, which can be highly misleading to individual and even many professional investors. A mutual fund marketing executive I knew years ago used to call this investment pornography. He said it's sort of intriguing to look at, but ultimately full of empty promises. So, let's explore some of these promises. The core promise underlying active management is that smart, hardworking investment managers with cutting-edge technology can outperform the overall stock market by actively buying and selling stocks or other investments. Although it seems intuitive that this approach would produce positive results, the evidence indicates differently. This slide shows a list of independent research studies that have been conducted over many decades on the performance of more active stock selection approaches. The data for these studies dates back to the early 1900s, and with overlapping periods since that time, the data is quite conclusive that active management has largely failed to beat more passive index strategies. In fact, I'll share a real-world example. I started my career working in equity research for a large Wall Street investment bank. We are perennially ranked as one of the top research departments on Wall Street, and every year our group would put together a fund that invested in the top ideas from the entire research department. To select the fund's investments, we formed a committee made up of research management, strategists, economists, and market technicians. On average, each of the committee members had roughly 30 years of Wall Street experience. Then, each of the analysts in the department, who followed the individual stocks and different industry groups, presented their best ideas for the coming year to this committee. The committee ultimately selected what they viewed as the 15 most promising stocks for inclusion in the fund. This was about as rigorous a process as you could imagine. The top people from one of the top firms using their best ideas, using significant technological resources and decades of experience. The end result? The fund often underperformed the S&P 500.
When you look at the data, it turns out a large majority of professionally managed investment products fail to provide returns in line or above what you could get by using a low-cost index fund that simply tracks the overall stock market. The problem largely is that all of the required ingredients for outperformance are expensive. Smart portfolio managers and analysts don't come cheap. Neither does cutting-edge technology. All of these costs end up getting passed down to investors in the form of mutual fund expense ratios. So, just to earn the return of the market, professional investors must outperform significantly on a gross of fee basis in order to overcome their fee and expense hurdle.
And the evidence of these frictions is pervasive. Standard & Poor's conducts a biannual study of actively managed mutual fund performance. S&P's data show that over shorter periods, the odds of a mutual fund outperforming its benchmark index are reasonable, although generally less than 50% still in most asset classes. Over longer periods, however, there are very few mutual funds that provide returns in excess of what you could earn with an index mutual fund. Although there are always some active funds that outperform, past winners are statistically unlikely to repeat in the future, making the job of finding truly stellar fund managers exceedingly difficult.
Right, and that makes past performance all but useless when looking for fund managers that will outperform in the future. In fact, one of my favorite studies done by Vanguard shows that rainfall predicts future stock returns just as well as past performance. You can see that on the current slide where the two red columns, rainfall and past investment returns, had the same explanatory power for predicting future stock market returns. Even the best predictive metric, the long-term Shiller price-earnings ratio, only explained 43% of future returns. Again, showing that predicting the direction of the stock market and the individual winners and losers in the stock market is exceedingly difficult.
Another problem with active management is that not only are you likely to earn lower returns than the overall stock market, but the penalties can be severe. This is another table taken from Standard & Poor's that shows the return shortfall of the average actively managed mutual fund in each segment of the capital markets. This indicates that across the various components of the stock and bond markets, the average return shortfall has been in the neighborhood of 1.5% annually.
And 1.5% may not seem like much, but it can add up to serious dollars over time. This graph shows the long-term impact of performance shortfalls because of fees and other frictions. The red line shows a portfolio that grows at 7% annually. If you started with $1 million, this portfolio would grow to a little under $4 million over 20 years. The black line assumes a 1.5% performance drag, so it only grows at 5.5% annually. Over that same period, it would only grow to a little under $3 million. The difference is $950,000 over 20 years. For long-term investors, keeping an eye on costs can add up to real dollars.
One objection to indexing we often hear is that index funds work fine as long as the stock market is going up, but there's no ability of index funds to get out of the market before a downturn. Active managers, on the other hand, have the ability to sell before downturns to help protect capital. Again, that's a good theory, but it doesn't seem to play out that way in the data. This table shows the number of active managers who underperformed during the 2008 financial crisis. In every category, a majority of active managers failed to beat the benchmark indices.
Perhaps that was just an anomalous period.
Nope, S&P studied the prior two downturns in 2000 and 2002 and found similar results.
A final consideration that we haven't addressed is the impact of taxes on active and index funds. Taxes are typically higher with active management because those funds generally have a higher level of trading within their portfolios, which can trigger capital gains tax. Index funds generally have low turnover or low levels of trading, making them less likely to distribute taxable capital gains. While taxes are often ignored in the investment process, they can be the highest costs investors face. Taxes and other costs can consume over half of your return if not managed properly.
So, keeping costs low, diversifying, and staying in the market with index funds is better than the vast majority of actively managed strategies. That might not be the message you get from the Wall Street marketing campaigns, but it's very clear from the data.